Liability companies. This is section 9 of the CSEC syllabus. Now, limited liability companies are in fact joint stock companies. Example, Elegant Hotels. And we sometimes call them corporations. So are there different types of limited liability companies? Well, we have two types of limited liability companies. Public liability companies, or PLCs, and private liability companies, LTDs. What's the difference between the two of these types of? Well, what we know is that public liability companies are allowed to raise their capital on the open market, or what we call the stock exchange. So they literally can sell their shares to the public. And secondly, they can have as many shareholders as are able to acquire the shares that they have put up for offer. On the other hand, however, the private liability companies, the LTDs, they are restricted from selling on the open market. So they sell their shares privately, usually by invitation. And their numbers are restricted to about a maximum of 50 shareholders. Nevertheless, all limited liability companies are legal entities. In other words, they are considered to be separate and distinct from their owners. So in other words, they have a personality of their own. And the owners of these limited liability companies are obviously called shareholders because they're the ones who own shares or part of the company. And therefore, the owner's liability in that company is limited only to the amount of share capital to which they have subscribed. That's why it's called a limited liability company. So we answer the question, so what advantage then would it be to invest in a limited liability company as opposed to, say, a sole tradership or a partnership? So let's look at the advantages first. What we know is that limited liability companies have separate legal entity status. Now remember, a sole trader and his business are considered to be the same person. But in this case, a limited liability company, one is separated from the other. And that is why they only have limited liability, which is their second advantage. Because now, as an owner, you are only limited to the amount that you have invested. Whereas, if you were a sole trader or in a partnership, even your personal possessions would be included in any debt settling. The third advantage limited liability companies have is that they are managed or operated by specialized management, people who are particularly and specifically trained to manage the resources of this company and to earn income for it. Now, you would notice that in a sole tradership or a partnership, the owners are also the managers, so they do the extra work to ensure that they earn the money. But here, the owners can sail off in their yachts or whatever because the management, the board of directors, the board of executives, whoever you want to call them, are the ones who have to earn the money for them. A fourth advantage that these limited liabilities have is that you can transfer ownership. Again, in a sole tradership or a partnership, you can't transfer anything. For example, if it's a partnership and a partner leaves, then technically that business is closed and a new one will have to open. And the same thing happens with a sole trader. If the owner leaves, then technically the business is done, and whoever decides to take that type of business will be literally taking out their own kind of business. But here you could transfer your shares to your aunt, your sister, your children, and the business will still continue. So obviously the fifth advantage is that it has a continuous existence. It doesn't stop because you stop. It keeps on going. And I guess the sixth advantage we can mention is that limited liability companies find it easier to raise capital because they're going to sell shares and people are going to buy into it. Unlike the sole trader or the partnership who has to sort of convince persons that their idea is going to work and that they'll be able to repay. But these limited liability companies are much larger, and so people believe that they have the capacity to pay back easy. Now, there obviously are some disadvantages to this type of business as well. For example, limited liability companies come under severe scrutiny from the regulatory bodies because they need to know everything that is going on there. And in order to know everything that is going on in those companies, they have to keep extensive records about what they are doing, because in most instances, those records will have to be published for all the stakeholders to see. Another disadvantage to the limited liability company is the fact that they are taxed twice. Now, limited liability companies pay corporation tax, so that's one tax on you out of the company, and then you, the individual, have to pay your income tax. So your dividends get a second lash from the tax body, the government. And of course, there are some other disadvantages, like it has a larger guess, is more complex to manage, and by the way, if a shareholder does something stupid, then he could be held legally responsible for his actions. But remember, his actions will also impact and sometimes people's opinions of the organization. So what do we know so far? We know that limited liability companies raise capital by selling shares. And those shares that they sell, by the way, must be authorized by a regulatory body. For example, the Registrar of Companies. And the shares are basically certificates of ownership in the company. And those shares will earn dividends which are paid to the shareholders out of the company's profits. So what kind of shares then are we talking about? Well, for the purposes of this syllabus, there are only two types of shares: preference shares and ordinary shares. How can we tell the difference? Now remember, all shares represent ownership in the company. So the only difference between these shares is the entitlements. Preference shares have entitlement rights, but no voting rights. So they are entitled to be paid dividends before the ordinary shares. And they are also entitled to claim the company's assets before the ordinary shares if the business folds. On the other hand, the ordinary shares have full voting rights, but no entitlement rights. So they can vote on company policy, the direction the company is going in, who will be the people to manage it, etc. But they will only be paid dividends after all other claims have been made on the company's profits are met. For one last thing, are there other ways to raise capital? Sure. We have debentures, which obviously is a long-term loan or security that comes at a fixed rate of interest. So it's guaranteed to be paid, and you have to pay before you even think about making profits. So it's usually secured against the company's assets. And then the other way would be through reserves, which is basically setting aside a portion of the company's profits for a particular purpose. For example, you want to set aside to buy some capital assets, or to pay off some long-term debts, or even to pay the employees some bonuses, or whatever. So those are some other ways in which. So finally, this question we will tackle when we review these notes again. So thank you.